CrowdStrike, ticker symbol CRWD, just reported earnings here after the bell, and the stock is down 6.6% after rallying 2% today and actually hitting a new all-time high. So we're going to talk about CrowdStrike. We're going to look at the good, the bad, the ugly. We're going to look at the earnings and everything in between to determine, is it a buy right now and is it a good fit for your portfolio? But before we do, if you could please go ahead, like and subscribe. It really helps me out. Let's start into it and talk about what CrowdStrike actually does. Now, CrowdStrike are a US-based cybersecurity company that provides endpoint security solutions specifically designed to protect against cyber attacks and malware, mostly in the enterprise space. Their flagship product, CrowdStrike Falcon, is an endpoint detection and response software, they call it EDR, that monitors computer activity for suspicious behavior and locks down threats. It also includes a next-gen antivirus offering called NGAV. Now, the endpoint detection response or CrowdStrike Falcon monitors computer activity on endpoints and responds to threats effectively. They also have a number of other products, including threat intelligence, cloud security, other solutions, next-gen antivirus, all for the enterprise space to protect your data and your customers' data. Now, CrowdStrike don't have any hardware. They are a cloud-first solution, so it's very light, very scalable, and they are the best in the business. They are the golden standard for the enterprise cyberspace. Now, looking at the earnings at a glance, you can actually see why the stock was down 6%. It has to do with this revenue figure. They missed ever so slightly. It was just a $7 million miss. The company still grew 19.8, nearly 20% on a year-over-year basis. And then on the earnings per share side, they did beat expectations. Analysts were looking for negative 46 cents. CrowdStrike came in with negative 44 cents. So the company did report a net income loss of negative 110 million. And that has to do with the whole range of things they're dealing with. CrowdStrike had a massive outage in 2024 in July. That put off a lot of systems, caused a lot of disruptions, and they're still actually dealing with that. That is why net income margin is actually negative here by 9.9%, which is in stark contrast to the same quarter last year. Free cash flow margin, however, was incredibly robust at 27%. And the reason why we actually saw a free cash flow reduction had to do with some minor acquisitions that the company partook in. And the company reported $298 million in free cash flow, down from the $333 million in the same year prior. Now, guys, gross margins did decrease ever so slightly. That's not pretty to see. However, the balance sheet is pristine, $785 million worth of debt, $4.6 billion worth of cash. And then looking at the Q1 at a glance, I know we just did, but looking at their ARR, which is what they guide for, the annual recurring revenue, is at $4.4 billion. New ARR for the quarter came in at 194 million. This actually beat the analyst expectation. Analysts were looking for 173 million this quarter. So they did actually beat on ARR. Very interesting. Now, CrowdStrike does have a 93% retention rate, or closer to 95. I've seen some figures. Let's just call it 90 to 95%. So a very high retention rate. So pretty much once they put a customer on, that customer is essentially a paying customer for life. And they've grown their ARR from 600 million to $4.4 billion in just the last 5 years. That is an 8x return. So extremely accretive business model right here. And so because of how their business subscription is structured, you get really predictable cash flows from this company. At the same time, their customers adopt their modules at a very high rate. You can see here that module adoption rates for 6 modules or more is 48%. So the more modules the company puts out, the more likely they will be adopted. And that is one way to capitalize on this recurring revenue, because essentially, even though this is a nominal figure, there are customers right here. And if you bring more modules online, that is a way for you to increase your overall annual recurring revenue, as well as with price increases, adding more customers, you just get that multi-pronged effect, which can see exponential growth in revenue. And that is how you get that 8x increase from 600 million to $4.4 billion in just 5 years. Now, looking ahead to the future, the company's guidance looks very messy, but essentially what they're guiding for right here in total revenue is for $1.14 to $1.15 billion. Now, the street was expecting 1.16, and this is part of the reason why we actually saw a little bit of a pullback in the stock in the after hours. Now, the reason why they missed guidance again had to do with that outage. When companies and enterprises are looking to renew their subscription, they're looking for a little bit of a discount because of that. So that is why the guidance came in a little bit soft, but you're still looking at 18% growth and 20% growth here for the full year in CrowdStrike's numbers. They're not diluting their shareholders. That's very, very good. And then you can have a look at all of these other metrics. But ultimately, what you really want to look for is the overall revenue. Now, the company is buying back stock. They're buying back about $1 billion in buybacks. This is largely just to offset dilution. And the company is valued at $124 billion as of today, or as of recording this. So, essentially not including dilution, they're buying back about 0.7% of the company, 0.75% of the company every single year. But you're not buying CrowdStrike for a single quarter. You're buying them for their long-term growth outlook. And you could see that even here in 2025, the expected cybersecurity TAM is $116 billion. Now, this doesn't tell us much without a comp. And when you look at the 2029 TAM, that's $250 billion. And this is a 2x increase, right? You're essentially doubling the TAM. That is about 15% compounded annual growth rate every single year. Now, CrowdStrike actually is growing faster than the TAM. That's very, very interesting. So they're taking market share. And if you're buying CrowdStrike, you're essentially saying CrowdStrike to take the lion's share of this AI native security platform, total addressable market in 2029. And I do think they're going to do that. I think CrowdStrike probably doubles their revenue through 2029, even more, I would say. Let's dive into their earnings in a more granular fashion. Now, revenue grew 19.7%. Now, you can see here that the cost of revenue, simply the cost of delivering those services, increased 28.4%. So the company isn't actually building any operating leverage every single year. They are still a growing company. And oftentimes when a company is in its growth mode, the cost of revenue will exceed the overall revenue growth, because they can actually cut costs a little bit later on down the line. It's better to just look at growth at all costs, especially for a company, CrowdStrike, especially with their business model. Once you get a customer in, a 95% retention rate tells you everything you need to know. Operating expenses was up 36%, mostly on the back of SG&A. They had to hire more individuals after that IT outage to ensure it doesn't happen again. And then their marketing spend also increased significantly. And I think they had to do that because of the outage. So, last year's outage really increased overall operating expenses by 36%. And that is how you get that net income loss of $110 million. So I think the company definitely has levers. They have levers in the SG&A segment. They have levers in the sales and marketing segment to deleverage and to sort of, build operating leverage into the business. But it's not really a problem for now, especially with the company growing 20%. The best thing that they can do over the next 5 years is add as many partners to their annual recurring revenue, introduce more modules, and that is going to set them up for very, very long-term success. Where does all of this leave us with valuation? And CrowdStrike is extremely expensive. Part of the reason why is because they actually aren't a profitable company on a net income basis. And that is why, price to earnings is like 125 times, though they can be excused for that. But even this is the next 12 months earnings. So at 125 times, you're really paying up for this stock. 87 times EV to EBITDA. I think that's more expensive than Palantir. And then the shareholder yield is negative 10%, even with a $1 billion buyback. So guys, looking at our valuation framework, now we use this on every single video. Now, number one, I want to preface this, take this with a grain of salt, because it doesn't really account for the true moat that CrowdStrike has. I think this is, I was doing a bunch of research into its products. It's probably one of the widest moat businesses I have ever seen. The product is super sticky, super effective. Now, there is that risk associated with it, that IT disruption risk. However, if the company can do 20% growth, through 2029, so that would assume it's going to take market share from its competitors, and you're looking at about $10.2 billion in revenue by 2029. Now, that does seem a bit frothy to me, but let's assume that. And then free cash flow margins expanding. I don't think this is going to be an issue for the company. I think we probably see free cash flow margins in excess of 39%. I mean, Q1 last year, free cash flow margins were 35%. So I don't think this is going to be an issue, but assuming 10 billion in revenue, right, on 39% margins, you get $4 billion here in free cash flow. Now, the current EV to free cash flow is 104 times. Now, we're going to use a 50 multiple. Now, this is frothy. And generally speaking, you guys know for these valuation frameworks, I like to use a 22 multiple because that's the market multiple. but we're going to use the 50 multiple now just because, essentially we're going to see a halving in the overall multiple of the business. At that point, you'll get an enterprise value of about $200 billion. Subtract the net debt, which is negative. So essentially, if you're subtracting a negative number, you add it to the equity value and you get 204 billion. Divide by shares outstanding, and then you get the stock price in 2029, right, which is $821. The current stock price is $488. So essentially, you're looking for about 11% compounded annual growth rate over the next 5 years, and then fair value would be $466. But all of this is dependent on a 50 multiple right here. That is very, very, very frothy, in my opinion. It's going to be very hard to sustain for that type of multiple for this business, even with the overall business model of CrowdStrike. So do take this valuation method with a grain of salt. But if these metrics hold true, you are looking at substantial upside here for CrowdStrike over the next 5 years. Now, where does that leave us with the technical charts? Now, CrowdStrike is down about 6%. And you can see that every single time we sort of touch this 200-day moving average, it's a great place to buy. So, if CrowdStrike does pull back to this level right here and this continues to move up, that would probably be a buy, especially assuming that these levels hold up and you could see CrowdStrike at the $800 level over the next couple of years. Now, this was the massive IT disruption. As you guys can see right here, this is when it actually went below the moving average. And every time it does get below the moving average, that does represent a great buying opportunity. This was a fantastic buying opportunity for CrowdStrike in hindsight. On a technical basis, I would say probably buy at the moving average. But, in general, you're going to have to see some very, very frothy numbers for this to work in. And having a 50 exit multiple, it always is a little bit of a red flag. So I wouldn't say CrowdStrike is a buy right now, but maybe if we get a pullback to I would say maybe 300 region, that would be a great place to add and go from there. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.